All right, let's get right into it. Today, we are pulling back the curtain on 5 totally legal tax strategies that can make a massive difference for you. This isn't about hustling to earn more money. It's about being smart and keeping more of what you already make.
So, if you're earning around $90,000 a year, this explainer is for you. That salary, believe it or not, makes you the typical full-time worker in Australia. Now, on paper, that sounds pretty good, right? But I'm guessing it doesn't always feel that way.
Yeah, this probably hits pretty close to home for a lot of us. You know the feeling between the cost of living, rent, groceries, that $90,000 salary just doesn't seem to go as far as it should. It is the classic middle-class squeeze.
And that gets to the real heart of the problem, doesn't it? You're kind of stuck in this financial no man's land. You earn too much to get any real government help, but at the same time, you see a huge chunk of your pay vanish to the tax office before you even see it. It can feel like you just can't get ahead. This right here, this is a total mindset shift. See, the real difference between just getting by and actually building wealth isn't always about how much you earn. It's that people on the wealth path focus on using the system, all the structural advantages that are already there, to keep more of their money.
So that's exactly what we're going to break down. We're looking at 5 of those legal gaps in the system that are just perfect for someone in your income bracket. The goal? To help you start making some real, tangible financial progress.
Okay, let's jump into our first gap. And honestly, this might be the most powerful one of them all. It's something so many of us just set and forget, but it can have a huge impact. Your super.
You've probably heard this called salary sacrificing, but really all it means is you choose to send a slice of your salary straight into your super fund before you get taxed on it. It's simple, it's legal, and wow, is it effective. And this chart shows you exactly why it's such a game changer. On a $90,000 salary, your tax rate is 34.5%, but any money that goes into your super fund, that gets taxed at just 15%. That's an instant saving of nearly 20 cents on every single dollar you put in.
So what does that actually mean in dollars and cents? Well, let's say you decide to contribute $30,000 of your income into super this year. By doing that, you could save yourself over $5,800 in tax. That is a massive win from just one move. All right, let's switch gears and talk about property. Now, even if you feel like you're completely priced out of the market right now, understanding these next 2 gaps is absolutely crucial for your future. Negative gearing. It's the classic Aussie property strategy. Basically, here's how it works. If the cost for your investment property, the mortgage, rates, repairs, add up to more than the rent you get, you've made a loss on paper. And the tax system lets you subtract that loss from your salary, which lowers your overall taxable income.
Let's look at a quick example. Your property brings in 20 grand in rent, but costs you 25 grand in expenses. That gives you a $5,000 paper loss. You can then use that $5,000 to reduce your taxable income from your main job, meaning you pay less tax on that $90,000 salary. For someone on 90 grand, even a pretty modest rental loss like that could mean an extra $2,000 to $3,000 back in your bank account come tax time. Think about that for a second. The tax office is effectively helping you pay for your asset.
Okay, great. But what happens if your property is actually making you money? Are all those tax perks gone? Nope, not at all. And that brings us right to gap number 3.
This is one of the best-kept secrets for property investors. It's called a depreciation schedule. You basically pay a specialist to create a report that calculates the value lost over time from wear and tear on everything from the carpets and the oven to the building itself.
And the numbers here can be kind of shocking. A good depreciation schedule can often find between $8,000 and $12,000 in deductions every single year. These are paper losses. You didn't actually spend that money this year, but the ATO lets you claim it as a deduction anyway. It's a huge advantage.
Now for our final 2 gaps. These are all about giving you an edge in the world of investing, especially shares. And they both have one thing in common. They reward patience. This one is a biggie. The capital gains tax discount is basically the government's way of rewarding you for being a long-term investor, not a day trader. All you have to do is hold an asset, like shares or property, for more than 1 year. If you do that, when you eventually sell, you only have to pay tax on half of your profit. The math is just fantastic. Say you make a $50,000 profit on some shares. Because you held them for over a year, the tax office only looks at $25,000 of it. The other half is essentially tax-free. This is a fundamental rule that smart investors live by. They buy and they hold. And finally, we have Franken credits. The easiest way to think about this is like a tax prepayment. See, when an Aussie company makes a profit, it pays company tax on it. Then, when it pays you a dividend, that dividend comes with a little note attached, a Franken credit, that tells the ATO, hey, tax has already been paid on this money. It's a clever way to stop your investment returns from getting taxed twice.
So we've looked at 5 very different strategies: super, property, investing. But what's the big picture here? What does this all add up to? Well, it's about completely changing your financial timeline.
Here's the real takeaway. By using these legal gaps to keep more of your $90,000 salary working for you, you can hit major financial goals, like reaching your first $100,000 in net worth years earlier than you otherwise would. You are literally fast-tracking your own path to building wealth.
At the end of the day, that's what this is all about. It's not about finding a higher-paying job or working more hours. It's about understanding the rules of the game and finally making the financial math work for you instead of against you.
Which really just leaves us with one final thought. The tax system is a game. It has a very clear set of rules. The question for you isn't whether the game is fair. It's whether you're going to learn the rules and start playing to win.